Hey, this is Arthur Hill, Chief Technical Strategist here at trendinvestorpro.com. Thank you very much for tuning into our YouTube channel. And remember, if you like this video, please give us a thumbs up and consider subscribing. And so today I want to dive into the S&P 500 because it's at a critical juncture long term. We're still in a short-term uptrend, but we're getting that big headwind from the longer-term downtrend. We've seen breadth deteriorate over the last 2 weeks. We also have a momentum indicator plunging below a key level, and we'll look at some signals with the 20-day high-low percent indicator. And stick around to the end of the video because I want to show you a post on a strategy that has a pretty nice equity curve based on a profit target. So I want to start off with a weekly chart, and this will show you why we are at an important juncture here for SPY. First of all, SPY has gone nowhere. The S&P 500 has gone nowhere for over 2 years. It's been up, down actually, down, up, down, way down, and now it's back and it's kind of in the middle of this big pattern, maybe just above the halfway point. But this was the decline that broke the bulls back. And now we've rallied back and we're below this 40-week moving average, which is sloping down. And if you look at price action over the last 4 weeks, it's very choppy and we're going nowhere. So that's why we're stalling at a very critical juncture. And that's why we need to watch those daily charts and identify that short-term uptrend and what it might take to reverse that trend. And if you reverse this short-term uptrend, you've got a continuation of the bigger downtrend. And that, of course, would point to further weakness. And the reason I think we're still in a bigger downtrend is we're below the 40-week moving average, and the 40-week moving average is falling. And I pointed out RSI is in its bear zone. It plunged below 40 there in February. And that was after months in the bull zone, which goes from 40 to 80. And now it's in this bear zone, which goes from 20 to 60. That is a bearish momentum zone because you can't get above that 60 level. The 60 level tells you you've got enough upside momentum to sustain an uptrend. But when you go below 40, that's when you got enough downside momentum to sustain a downtrend. And that's where we're at right now, longer term. And I was also looking at the breadth indicators for the S&P 500 in particular, and this is advanced decline percent. And when it goes below minus 80%, as it did the last 2 weeks, twice in the last 2 weeks for the S&P 500, that means more than 90% of issues in the S&P 500 decline. So you can see on that decline that we had last week, we had a minus 80% down day. We got a bounce, and then we had a minus 80% down day on Tuesday. And in between, we couldn't make it above 80%. So that tells me that buying pressure is waning and selling pressure is starting to pick up within the S&P 500. And I think the S&P 500 is the one to watch. I don't think relative strength in small caps is a positive or a negative. They're going to follow the S&P 500. But small caps are underperforming overall, as we'll see with the IWM chart, and that points to probably leading further on the way down. So here is SPY, and technically the short-term trend is still up, even though you've got that bearish engulfing pattern form. And the difference between candlesticks and, say, an outside reversal is a bearish engulfing candlestick is based on opens and closes. So you've got this open here of this black candlestick above the close of the prior white candlestick. And then you have a decline during the day, and the close of that black candlestick is below the open of that candlestick. Now, in contrast, an outside reversal day happens when the high is above the high and the low is above the low, and you have this reversal from a strong open to a weak close. So it's also an outside reversal day because you're completely outside that prior high-low range. Now, you can see we're below the falling 200-day moving average, so we do have a long-term downtrend in play. We're at this 61.8% retracement line, which is where you would expect a counter trend bounce to peter out. And then you can see we're stalling now. Now, there's two sides to every trade, and the other side would be that this is maybe some sort of bullish pennant forming. You got to keep an open mind. So, we've advanced here, a bullish pennant is forming, and if we get a breakout there, then that will get this uptrend going again. Now, on the downside, you can see we've got support here at 280, and if we break that level, that's going to be a reversal of the short-term uptrend and call for at least a pullback of this advance, if not a continuation of that first leg down. Now, there are three indicators that I'm watching on this chart, and we've already got a bearish momentum thrust, if you will. And first, let's look at RSI. So you can see RSI moved above 50 there on April 7th, and it remains above 50. And that means the momentum cup is half full when you're above 50, the midpoint of RSI. And if we move below 50, then that would signal a downturn in momentum, and that would probably happen if we get a support break up there, and that would be a trend reversal signal as well. Now, the two early warning signals that we have are in Stochh RSI and the percentage of stocks above the 20-day EMA. So if you look at Stochh RSI, it is the stochastic oscillator applied to RSI. So it's basically measuring the momentum of momentum, and that would be velocity, if you will. And as a momentum indicator, you've basically got RSI, which is an indicator already, so it's one step removed from price. And then you got Stochh RSI, which is another step removed from price. So it's a second derivative. And the further you get from price, the more, volatile your indicator signals are going to be, or less reliable. But they can work. And if you look at Stochh RSI, it moves above 0.8. That signals a momentum upthrust. And we got that momentum upthrust in March there with this move here. You can see these prior attempts did not get above 0.8, and this one did. So that was a bullish momentum thrust. And you can see we got a couple of downward moves in Stochh RSI, but this is the one that pushed it below 0.20 for a bearish momentum thrust. And that's the first sign that we could be peaking here. Now, if we look at the percentage of stocks above the 20-day EMA, that's a breadth indicator that gives you an idea of participation. So we were making it above 80% 3 times, and then you can see on this attempt, we didn't get above 80%. So that tells you that fewer stocks made it above their 20-day EMA. That's less participation as we're up here at these high levels at this critical juncture. And if we already broke below 50%, so that's a negative. So the early warning signals of a reversal are here. And the second thing to look for would be a support break and an RSI break below 20. So I use the 52-week high-low percent indicator for my index breadth model. And that is the percentage of 52-week highs less the percentage of 52-week lows. And it goes above 10%, that's bullish. It goes below minus 10%, that's bearish. Now I've got here is a shorter term version of that. It's 20-day high-low percent. So it's the percentage of 20-day highs less the percentage of 20-day lows. And there you can see that's that histogram there in the second window just below the price chart. And so when it moves above plus 10%, you've got a bullish signal and the shading turns green. And when it moves below minus 10%, as it did at the end of February, the shading turns white, or there's no shading, and that is bearish. And so we got that bearish signal, and we got a bullish signal. And if we look at the histogram, it's still holding positive, barely, and it would need to move below minus 10% for a bearish signal. Now I've separated out the indicators below. So this is a percentage of 20-day highs, 10.9%, which is a little lower than the day before, which is lower than the day before. So a little bit of deterioration. And you can see the percentage of 20-day lows has gotten above 10% twice. So we're seeing some weakness starting to creep in within the S&P 500 in this breadth indicator, and I'm watching for that signal. Now, a couple of the recent commentaries we have on trendinvestorpro.com, if I scroll down, I did a really big report on, well, not a really big report, but I published the equity curves for all 12 months. And these are 30-year equity curves that show you how seasonality worked over a 30-year period. We get a snapshot of seasonality by looking at the total return each month, the average return each month, and the percentage of times the month is up. But it's that equity curve that tells you how steady and consistent that seasonal pattern is. And that's what we see in this report for all 12 months. And another one I want to point out was a profit target can really help your equity curve. And this was an article where I back tested a strategy, and there's the equity curve for that strategy. And you can see there are the drawdowns that we're getting, and drawdowns are going to happen, but it's a very nice and steady equity curve. And what helped this equity curve was adding a profit target. And I did some sensitivity testing a 60% profit target with different positions. And I also tested different profit targets based on 16 positions. And this was an ETF portfolio. It's a 50 ETF portfolio. That's an all-weather portfolio. You have 10 alternatives, stock alternatives, designed to pick up the slack when you don't get signals in stocks. So if you're interested in any of what you're seeing, you can check out trendinvestorpro.com. Very reasonable subscription rates. Thank you very much for tuning into this video. If you like it, give us a thumbs up and consider subscribing. Have a great day.